thank you for joining us. We are very excited to welcome one of Wall Street's renowned growth investment advisors, Louis Navellier. He is the founder and chairman of Navellier and Associates, a money management firm, and he specializes in behavioral finance and utilizes extensive quantitative and fundamental analysis to identify market-beating stocks. He's also the editor of 5 investing newsletters, which are published through Investor Place Media. Mr. Navellier, thanks for joining us.
Oh, it's an honor to be here. Okay, so it's time to show you my fancy presentation here, and I look forward to talking to you folks the next 30 minutes. The main thing I want you to know is that the stock market and as well as gold and residential real estate are being fueled by the fact that interest rates are going to be at 0 through 2023. And the truth of the matter is they're going to be at that level probably far beyond that. It doesn't matter whether President Trump or Joe Biden becomes the next president, because the federal budget deficit is now over 100% of GDP growth each year. They put themselves in a box. They can't raise rates anymore. So this makes the interest rate sensitive sectors of our economy very good. This is also very inflationary. It undermines the US dollar. And one of your best inflation hedges in a zero interest rate environment, inflationary environment, is the stock market. So I look forward to explaining to you why this is happening, and I'll show you some of my best stocks here. So let's talk about this dilemma the Federal Reserve has gotten in. The main thing I want you to know is the Fed had to uninvert the yield curve a while ago. But they're trying not to fall into this black hole of negative yields. Now, just so you know, Europe is negative, Japan is negative, and the Bank of England was fighting it, but they surveyed their member banks here recently, and they expect to fall into negative yields as well. So here's where yields are in Europe. A year ago, they were in yellow. Now they're in green, and you can see they're lower than they were a week ago, a month ago, a year ago. And capital sloshes back and forth around the world, and normally money flows into America because we still have positive rates. Europe and much of the rest of the world have negative rates. But just the election rhetoric and our political infighting has undermined the dollar since March. Now there are weeks the dollar gets its mojo back, for lack of a better word, but when our Federal Reserve talks, they are manically depressed. So that's actually very, very sad, okay? And I want you to be aware that that even though we have higher rates than the rest of the world, just the demeanor of Fed Chairman Jerome Powell really puts a damper on the U.S. dollar, and a weak dollar is why inflation's perking back up. And by the way, the Fed purposely wants inflation to come back. Okay, so here in yellow is where we were a year ago, and now you can see where we are at this moment. You know, the Fed is controlling various parts of the yield curve. Normally, the Fed just controls short-term rates, but they are not only, they're controlling the 5, 10-year with their quantitative easing, their aggressive bond buying. They're also controlling corporates, mortgage-backed securities. The Fed's been very, very busy. And our Fed is to put more stimulus in than Europe. And that is also one reason the dollar's been undermined. Interesting environment we're in. So if you look at the 10-year yields, they actually have a real negative yield versus inflation. And if you look at something called the TIPS rate, which is Treasury inflation protected securities, they actually have a negative yield too. So we don't have absolute negative yields on the 10-year yet, but we do have real negative yields minus inflation, and the Treasury inflation protected securities have a negative yield as well. Now, when we look at our government, we have a chart here of the receipts and outlays. The receipts are in dark blue, and the outlays are in light blue. And on a podcast this morning, I was discussing the conundrum we have right now. You know, new claims for unemployment just rose. They're at a 7-week high. Continuing claims continue to fall. However, the problem with unemployment is California hasn't reported for 3 weeks. they've frozen all the unemployment claims processing because there's a lot of fraud claims in the system. And you know, October, especially in election years, we tend to October surprises. Don't be surprised if California starts to report just before the election, you get another spike in unemployment claims. But you know, it's kind of hard for the government to collect more receipts when you know, certain parts of the economy aren't functioning well. But you know, this is going to be a problem. And of course, there's a $1.8 trillion stimulus package that's been offered by the White House that Nancy Pelosi has rejected. The contentious bit is how much aid goes to state and local governments. The White House has $300 billion in that $1.8 trillion for state and local governments. Pelosi wanted a lot more, so we'll see. And debt as a percent of GDP is now becoming unbearable. It's crossing the record levels, and this is why they can't raise rates. Even if they try to raise rates, they can't pay the interest. So that's why rates are going to be at or near zero through 2023, which the Fed has confirmed. But in my opinion, it's going to last a lot longer than that, basically the rest of our lifetimes. Now, the Atlanta Fed, believe it or not, is still estimating 35.2% GDP growth. And the Atlanta Fed tends to update every week. We'll probably get a revision tomorrow. But this is very bullish, okay? And most of the economic news is still V-shaped, okay? So, you know, when we go vote, it's really boiling down to a health versus wealth debate. Do we want to grow our way out of this mess? Do we want to let the states control our destiny? You know, Florida is pretty much wide open. California is still shut down. You know, we're fortunate that we have 50 states. We'll see which state has the best model. But, you know, yeah, we are in the midst of a very, very good economic recovery. And the question is, do we want to stifle it again? Okay. First, I don't think we can afford to stifle it again. And second, it's against human nature to lock us all up. Now, as I speak to you today, you know, Paris has more lockdowns. The UK put on more restrictions even among family members gathering and things. And then Milan has a rising COVID cases in hospitals and things. So they're starting to get a little alarmed. But obviously Europe, they live in the big city centers more than we do. And we're very fortunate in America, we're spread out more. And of course, you may know some of our city centers are kind of ghost towns now. So, you know, it looks like we can grow our way out of this mess. Obviously, we have better treatment now. President Trump was treated with an interesting mix of antibodies and other steroids and some other things that weren't initially available back in March. They didn't know as much. And then, of course, they've already paid for the vaccines being manufactured, even if they're not approved. And so hopefully between the better treatment, the fact that the vaccines are around the corner, we are going to continue to grow our way out of the conundrum we're in. In the meantime, the deficit has exploded. The amount of Treasury securities held by the public is massive. The budget deficit is massive. You know, if I went back to March and April, you know, the U.S. savings rate hit over 33%. So when we stick our money in the bank, the bank buys treasuries. So if you wonder who's buying all these Treasury securities, it's you. When you hoard cash, your bank is buying treasuries, just so you know. So there is a lot of cash on the sidelines. And one of the interesting conundrums we have with the market is we've gone up on light volume, and what's going to happen with all this cash on the sidelines comes back in. So as soon as we get rid of the election uncertainty and as soon as we start to cheer up, it's going to be interesting. In the meantime, we have this incredible deficit. You know, this is the blue line shows you what we were on track for. Now, the orange line shows you what's happened because of COVID. And now we expect to end that now that we're pushing 100% of GDP on our deficits, we think we're digging ourselves a hole we're not going to be able to get out of. Now, I want to talk to you about some weird things that are going on in the market, just to kind of educate you. You probably know that SPY, which is the S&P 500 ETF, is very popular. You probably know the QQQ, the NASDAQ 100, is also extremely popular. These big indices are cap weighted, so the big stocks get bigger. Today, over 22% of the S&P 500 is in 7 giant tech stocks. That's Amazon, Apple, Google, Facebook, Microsoft, Netflix, and Nvidia. Of those I just mentioned, we happen to own Microsoft and Nvidia in managed accounts. The NASDAQ 100 is even more concentrated, so the big are getting bigger. However, we've had an incredible small cap rally here in the last 3 weeks. So the money is moving around, it's shifting. It looks like we already have an early January effect underway. But there's something evil about ETF trading I feel I must tell you about. And that is, if you buy an ETF at the opening and you sold it at the close, in other words, you day traded it, since its inception in 93, you'd lose 8.5%. On the other hand, if you bought at the close and sold at the opening, you'd make over 700%. So ETFs have spreads. And because Wall Street's fighting for order flows, and because they make so much money on spreads, commissions today are free. The reason you have free commissions is they're fleecing you on spreads. And let me show you how dramatically it's affected the performance this year. So this year, we happen to have the S&P 500, and the full day is in purple. If you buy at the open and sold at the close, that's in red. And normally that doesn't do as good, but this year it's done okay. And then what has historically done the best, buying at the close, selling at the opening, hasn't done as well. And that's probably because there's big market moves pre-market. And in fact, we have one today. The market gapped down today because Europe gapped down. And so basically the opening of the US markets have been controlled by Europe and Asia more than anything else. But I just want you to know, don't overtrade your ETFs. If you want to know how to buy and sell ETFs, you go to morningstar.com, you key in your ETF symbol, and it'll tell you something called intraday indicative value. And it'll be different than the current price. And if the spread's 1 or 2 cents, go ahead and buy. If the spread's 20, 30, 60, 70 cents, then wait. You're going to have tighter spreads at the opening, tighter spreads at the close. But ETFs are alive, and during fast market conditions, I've seen big liquid ETFs like DVY, it's iShares Dividend ETF, fall 34.95% in 90 minutes. Yet at the end of the day, the spreads were back to normal. So, do not trade ETFs for trading reasons, okay? You're gonna dig yourself a transaction grave. Also, Wall Street's pumping out ETFs that are designed to fleece you. The pod ETFs, the blockchain ETFs, theme ETFs tend to have wider spreads. So it's okay to buy an ETF and hold it for several years, but it's not okay to trade it, and you get dramatically different performance changes. But always go to morningstar.com before you place your order, check and see what the spread is. Okay, well, the seasonally strong time of the market starts on October 18th. That's Sunday. And we've told everybody that has cash on the sidelines, make sure you're invested by this week, because we think our stocks are going to take off from October 19th on. So I just want you to know that we're in the midst of a very good earnings season. I know the financials have had lackluster results, but I don't recommend financials. I'm an ex-banking analyst. I know better. And banks tend not to do well in a flat yield curve environment. But I can certainly tell you, when the earnings start to kick out next week for our growth stocks, they're gonna be doing very good. And we got a lot of seasonal reasons to rally. So we are going to be in the zero interest rate environment for a long time, and you need to know where to turn. So we like dividend growth and then go growth stocks, so benefiting from raw economic growth. So I'm going to tell you how to find these now. Before I do, I want to alert you that the Dow right now is yielding over 4 times the 10-year Treasury yield. The S&P is yielding over 2 times the 10-year Treasury yield, almost 3 times. So obviously these dividends that the Dow and S&P pay are largely qualified, and they're going to be taxed on a max federal rate of 20%, although if you do have over $250,000 in dividend income, they're going to throw an extra 3.8% tax on it. But that's better than paying the 37% tax, which is, again, if you make over $250,000 a year, they'll throw another 3.8% on. So the bottom line is, if you need yield, the stock market's going to give you a higher yield than bonds. You know, my firm's biggest business on the management side is bonds. And we just did a BBB corporate bond portfolio. We went out over 6 years and we can only get a yield of 2.65%. So, you know, you can cherry pick stocks and get a great yield. So the stock market is your oasis right now. Now, when we look at the recovery from the March lows, we see that the QQQ, the go-go NASDAQ stocks, definitely led the way. Then you see the S&P 500 is right behind it. And then finally, the dividend stocks really have not been recovering as well. So a lot of these dividend stocks are great buys right now. And we're actually showing the iShares Dividend ETF, DVY. But there are stocks increasing their dividends. I can name them for you. Costco, Johnson & Johnson. I have a REIT called ABR. It's increased its dividend, okay? So, so dividend growth is the place to be, in my opinion, more than high dividend. And let's get into how to find some of the best dividend stocks. So my dividend research is online, available to you folks free. You just go to www.navellier.com. You can also go to www.navelliergrowth.com. That's the newsletter site. So navelliergrowth.com is the management company site. Navelliergrowth.com is the newsletter site. So we have two different websites. This is the one from navellierr.com. And we happen to show you how we grade dividend stocks on an A, B, C, D, and F basis. The A's are strong buys. Okay, those are the ones you want. They tend to last 5 months or more. I often own A's and B's to get you long-term gains. C's are holds, D's are dogs, and an F's a dog with fleas. Now, I've taken 3% off these charts on annualized return because I'm registered with the SEC, and showing gross numbers is not kosher with the SEC. So they want us to knock the numbers down a little to give you a more realistic return. They don't make us knock the S&P down, but they make us knock down how we sort stocks. So anyway, I want to show you some of the best A-rated stocks, and let's get to that. And actually, we have one B-rated stock right now. And so Amgen is an A-rated stock, yields 2.64. Fastenal is another A-rated stock, yields 208. Illinois Toolworks was A-rated, it just slipped to a B, but yields 2.11. Kroger, great buy near term, yields 192, also A-rated. PetMed Express yields 343, A-rated. And Texas Instruments has been a great dividend stock for a long time. It's A-rated, yields 239. So these are examples of dividend growth, okay? So take advantage of them. You can go to our website, you can key in your stocks, you can actually save the portfolio. My research is online, available to you free, but I do want you to know a dividend growth stock is going to do better than a high dividend. Now you probably know that AT&T yields 7%, okay? But it doesn't increase its dividends. AT&T is in the process of refinancing a lot of its debt to get its cash flow better. So is that AT&T dividend going to be sustainable? We're going to find out. You know, 5G and some other things are probably going to help AT&T, but you know, the traditional landline business is obviously suffering. All right, I just want to talk to you about growth versus value. Growth is in red, value is in blue. And value has not worked for 12 plus years. So I highly recommend, okay, that you do dividend growth and go growth, okay? If you try to do value investing, whether it's on cash flow, P ratios, price to sales, whatever your metrics are, I don't think you're going to be doing good. You know, we have a very optimistic president. We're a very optimistic society, and everybody loves their growth stocks. I want you to know the dividend growth is also a very good strategy. So I want you to stick with growth, and I don't want you to buy value strategies at all. If you need any evidence of this, we happen to show you the large cap growth stocks in red here. And then the mid-cap growth stocks in blue have done the next best. And then the small cap growth stocks in green have also done well. You might notice in the blue and green chart that they've been rallying more confidently, more strongly in the last several weeks since the second half of September. There's something called quarter and window dressing that we benefit from. There's a 90-day ETF realignment. ETFs rebalance every 90 days. It helped a lot of those stocks. And then we entered October very optimistic. So the small cap stocks are going to have better earnings than the mid cap stocks, which are going to have better earnings than the large cap stocks. But a lot of people naturally like large cap just because of liquidity. And you can see there's 3 value indices that are trailing. Okay, so growth is better than value, period. Okay. All right, let's talk about how to find the best growth stocks. This is our stock grader on Navellier.com. It's called Portfolio Grader on NavellierGrowth.com, our newsletter website. The main thing I want you to know is obviously A-rated stocks are the best, and these stocks are typically A-rated for 7 months or more. I have to buy A's and B's to get you long-term capital gains. But if you have a pension, just chase the A stocks and you'll do better than I do. We happen to show the C's, D's, and F's as well. So let's get into this. By the way, these charts are also knocked down 3% a year, okay? Because that's what the SEC wants us to do. So here's an example of some great A-rated stocks. Camping World, great buy today. Cyber Optics, another great buy. SSC, got out of the S&P. Remember they all thought Tesla's going to get out of the S&P? Well, they added SSC instead. Quindel, which is COVID testing, is an A-rated stock. Sportsman's Warehouse, phenomenal company. This company has 61% same-store sales growth. This company sells camping gear, fishing equipment, and guns. So how much of its 61% same-store sales growth is camping versus and fishing versus guns? I'm not sure, but they're all up. And finally, Meridio Bioscience, VIVO, is also an A-rated stock. These happen to be, a lot of these stocks happen to be coveted AA stocks. To get an A in our quantitative criteria and our fundamental criteria, you have to be in the top 20% of sales growth, margin expansion, earnings stability, earnings revisions, earnings surprises, earnings momentum, return on equity, and cash flow. Only 1 out of 300 stocks get a coveted AA. So I just want you to know that. The other thing is, you might wonder, what is our quantitative grade? It's essentially alpha over standard deviation. What it is, it's alpha is the stock's return independent of the market, uncorrelated the market. Standard deviation is just its volatility. Now we calculate these alphas and betas and all this statistical stuff against different market benchmarks, and we always use the benchmark with the highest correlation. That way we get better data. We also do it on a trailing 52-week basis, although we test different time cycles. So these databases are updated every week. We are very, very proud of these databases. I can't tell you enough how I rely on them. This is how I manage money. But we give you all our research away free because it's the right thing to do. We want to educate you and we want to empower you. And a couple other things about our databases I want you to be aware of. Let's just say the market's up 50% in the past year, and another stock's up 100%, in other words, double the market. Let's say the stock that's done double the market has moved in tandem with the market. Under our system, it would get a beta of 2 and an alpha of 0, and it would miss my radar. We only want stocks that zig when the market zags. You see, we're trying to control our own destiny. We don't care about the election outcome. I mean, we'd like it not to be contested, but doesn't affect our system. We want our best defense to be a strong offense, because we know that we can go in every earnings season locked and loaded with fundamentally superior stocks, and normally those earnings will drop kick and drive our stocks higher. And so when earnings are on, we're on. And I can't tell you how important this is to us. This is not a relative strength system. This is a system that finds stocks and move independent of the market. And then we scour them for under an 8-factor fundamental model here to verify they're great fundamentally. This morning I had some people ask me about some other stocks, and they look good on the surface, but they didn't pass our fundamental criteria. So I told them not to buy them. And that's how our system works, okay? Um, so I want to back up here and just explain to you what's going on with this market. The market got too concentrated this year in the mega caps, okay? They're still doing well, but it could end badly one day. You know, back in the go-go 90s, the big stocks were dominating the index, and the bubble burst in March 2000 when 54% of the S&P was in 9 giant tech stocks. We're not there today. Although we have concentration in the S&P and the NASDAQ 100, a lot of those stocks still have good sales and earnings. Now today, some of them are down because they're censoring the news. Okay, you probably heard about Hunter Biden's computer being found, and the New York Post blasting it out. But not only do they censor the Twitter and Google censor the New York Post, they censored the White House press secretary and some other folks. And they said, well, it's because it was obtained illegally. Well, you know, so it's Trump's tax records. So, you know, they're under a little scrutiny right now. And, you know, if Biden gets elected and we have a Democratic Congress, they really want to go after the big techs, okay? So it's just interesting what's going on. But I don't have to worry about any of that because I know I've got over 30% sales growth. I've got over 60% earnings growth. I'm going to have at least 20% earnings surprises. And now we're at the seasonally strong time of year. I showed you that chart earlier from October 18th on, we tend to have a great year in rally. And not only, and October is actually a very good month. It wasn't good in October 87, but in the last 30 years, it's been great. So I'm expecting great earnings to come out. I do expect another little pause, stutter step, maybe the second week in November after the election. And then if it is contested, hopefully it'll be resolved by then. And then we rally headed into Thanksgiving. Thanksgiving's a happy time of year. Friends, family, football, food, that kind of stuff. A lot of year-end pension funding goes on. Now, Biden becomes president. Yeah, maybe there'll be some tax selling, things like that. But as far as I'm concerned, it's lock and load time here, folks. We're in a V-shaped economic recovery. I can look at producer prices. I can look at durable goods. You know, the purchasing manager indices. You know, tomorrow we're going to have retail sales. I mean, it's, you know, consumer spending on goods is higher now than it was pre-pandemic. And I know a lot of our service workers are still unemployed, and I know that they're hurting. You know, if you're in the travel or leisure, hospitality industry, it's really tough out there, restaurant industry. But, you know, the world adapts, and we have stocks that have adapted and are prospering in the current environment. The other thing that's so amazing is productivity soared as the economy recovered. Apparently, if we work at home, we're more productive than if we're stuck on a freeway. So fascinating times we're in, folks, just fascinating. But all I know is I have oasis stocks out there that are an oasis amidst the chaos. Today, you'll find stocks like DocuSign, Zoom, doing very, very good. So I feel good. I just think we should grow and prosper and not worry about everything you hear out there. All right. Well, we've almost taken up all your time. I just want to answer some popular questions I get. I do get a lot of questions. 85% of them are about the election. So here's the deal. It doesn't matter whether it's Trump or Biden. We just don't want to contest it, okay? The stock market tends to do good under Democratic administration. They'll spend up a storm. The more they spend, the less rates can go up, and the more inflationary it'll be. And your oasis is the stock market, hot residential real estate. You know, some residential real estate's hot because people are fleeing to suburbia and all. And then finally, gold is an oasis in an inflationary environment. So that's your oasis. Now, if Trump's elected, then you have a cheerleader for the stock market, okay? And so that's good too. But he's going to also run big deficits because he wants his legacy to be the strongest economic growth that anyone's ever had. So I'm not worried about the election outcome as long as it's not contested. If it is contested, let's hurry up and get it over with. Hopefully it'll just be, you know, I think 8 states are swinging the election, and we'll see what happens. It looks like it's going to be a low turnout election, low turnout on the Democratic side, high on the Republican side, but we shall see. You know, in the past, John Kerry won, according to the news media. Hillary Clinton won according to news media. So I don't really trust the polls. And I think a lot of you folks know that a lot of the Trump people out there keep their mouth shut and just vote. So fascinating times. We'll see what happens. Okay. But the main thing is to have a decisive outcome, get the election over with, and then grow and prosper. And that's that. Markets are very seasonal. There's year-end pension funding. There's pension funding in the new year. Okay, another popular question I get is, why don't I just buy index funds? Well, absolutely you can. You know, I'm from Berkeley, California. I was taught that it is immoral for us to try to out-earn our neighbors. So therefore, we must conform and just buy index funds so we all have the same return. So if you believe in that social norm, that it's immoral for you to out-earn your neighbor, yeah, buy an index fund. There's also a big boom now in ESG investing, and I think there's too much ESG money, but I think it's important to talk to you about it. ESG is environmental and sustainable governance. This is one reason that although energy is 8% of our economy, it's less than 3% of our stock market. There's 38 states won't buy fossil fuel investments. I've been in California a lot this week. I'm back in Nevada right now, but you know, they've banned natural gas in all new construction. Okay. You have to put up a power wall if you want to run your house. You can get a generator if you're a commercial or nursing home or something, but most of the time you have to put in a power wall because they don't want any fossil fuel device powering your house. And then shut off power in fire season. So there are stocks that we have like Enphase Energy and Solar Edge. They make the inverters that do all the switching in California. So homeowners can have power when they lose it during fire season. You know, there are ESG investments that are out there pretty hot. Solar Edge, again, Enphase would be our best. But, you know, I just think the bottom line is when earnings are on, I'm on. That's what we at Navellier are all about. Our growth portfolios are low beta. You can believe it or not, our large cap growth portfolio has beta 0.78. We also do tactical management, goes in and out of the market. If you don't want to be full invested, that is beta 0.55. So we think our best defense, strong offense. That's what we're all about. I hope you've learned a lot today. I hope you learned that interest rates are going to be at zero for a long, long time. And I hope you know that dividend growth stocks and conservative growth stocks are your best oasis in this zero interest rate environment. And with that said, I'll turn it back to our hosts at MoneyShow. It's been an honor to talk to you folks.